everyone, my name is Bernard Doyle, JBWere Investment Strategist. Markets are still somewhat jittery through the month of February, and maybe this is spilling over into March. The sell-off at the start of the month was very short, and there is still grounds for volatility remaining in markets for a little while longer. There are always reasons to worry, and recently the steel tariffs and aluminium tariffs announced by President Trump may be adding to uncertainty. But if we go to the heart of why investors have suddenly become a little more jittery, we think it is still about the Federal Reserve, and in particular there remains a big gap between what the market has priced for future interest rates and what the Federal Reserve believes they are likely to do. And until that gap closes, we're likely to see these somewhat jittery conditions remain in place. Now that's, as we've said before, that's a big distinction between a market environment that's a bit more volatile and the end of the bull market. End of the bull market will most likely be caused by a recession, and importantly, we really believe recession risk at the moment is low. We're seeing very strong economic data coming out of the United States. We're seeing good numbers coming out of other parts of the world. We've just had tax cuts implemented in the United States, which is giving more money to consumers and businesses to spend. So it would be very surprising to us if the world, out of the blue, fell into recession and caused a bear market. Of course, other things can cause equities to remain in trouble. But even there, we're reasonably relaxed. We've had a very good earnings numbers coming out of the major markets. The US had one of its best reporting seasons ever. So again, it would surprise us if this turned out to be something more substantial. Having said all that, it will take time for investors to get their head around this idea that maybe inflation is not dead and buried. Maybe it's coming back in some magnitude. And that means higher interest rates, and so that does have some implications for equity prices, and I think that's really what the global markets are working through at the moment. Now, a quick word on New Zealand. Late last year, we were a little worried that some of the indicators of New Zealand growth were starting to look a little wobbly. We had immigration falling, we had house sales that were very low, we had a new government that was spilling over into business confidence. So I'm happy to say that in the first few months of the year, we're starting to see those signs stabilise. Business confidence has not fully rebounded, but it's recovered somewhat. Likewise, we've seen house sales pick up off the floor, and so both of those things are a good near-term sign. Medium term, really good to see for growth, immigration not falling sharply, and in fact has made back some ground in the last month. Having said all that, we still think New Zealand growth needs to be less dependent on population. But in terms of are we going to have a sharp slowdown this year, we think the risks there have actually diminished since the end of last year and immediately following the election. Of course, for us, that doesn't make the New Zealand equity market particularly easy. It's still a very interest rate sensitive market, so it struggles in a period of rising bond yields, which we're going through at the moment. So we still suggest investors hold a little less exposure to this market for now, particularly while those bond yields are rising as they have been. I'll finish there. Obviously we'll keep you up to date as we see things evolving over coming weeks and months. If you have any other questions, as always, please get in touch with your JBWere advisor. Thank you.